everyone, and welcome back to our second review of the week in markets. I'm joined here by Paul Durrans, our investment director from the investment team. What we're going to do today is review this week in the markets and what we believe has driven the volatility that we've seen. So, Paul, give us a broad comment on this shortened week. The US, of course, was closed for Martin Luther King Day on Monday, but from Tuesday, how would you characterise events?
So we've seen a pickup in market volatility, particularly within equity markets. And so we've seen a little bit of weakness, broad-based, but specifically more weakness coming through from Asia and in particular China. We've seen a little bit more volatility within bond markets as well, and commodities, a little bit of weakness, but a pickup in bond yields as we've seen slightly stronger economic data coming from the US and slightly more disappointing data from the UK, which is changing the interest rate expectations within the markets.
And of course, we say disappointing in the UK, but it's disappointing for markets. But it's not necessarily disappointing for the economy, because on Tuesday, the employment data for December came out. How would we characterise that?
Exactly. So, yeah, good news from the UK from an economic perspective, because unemployment is remaining at 4.2%. So no change on the month. But better than what economists were expecting. And that's good for UK economic growth as well. So if people are in their jobs, they're earning, and therefore they can spend and the economy can keep going.
And encouraging data on the average earnings side. So this measure of pay awards in the economy, how would we characterise that?
Exactly. So for developed economies, and especially the UK, they've been challenged by higher wage growth. So people have been earning more, but the challenge with earning more, they can spend more and more willingness to pay higher prices, and risks really inflation being stickier for longer. So over the last 12 months, we've seen UK pay growth reach 7.9% at its peak. It's been coming down, but on Tuesday we got more confirmation that wage growth was trending even lower. So if we take wage growth excluding bonuses, they've come down from 7.2% to 6.6%. And when we factor in bonuses themselves, we see a similar trend.
And of course, we've talked about inflation momentum in the past, and we translate that through to these wage measures. We're actually seeing much lower wage price pressures there. So we could even see a real downside surprise in wages going into the spring and the summer. So let's deal with inflation then. Wednesday, UK inflation data, a bit of a surprise there.
Yeah, so we saw headline inflation rise slightly from 3.9% to 4%, so slightly above what the market was looking for, and it was due to strange things like tobacco duty. And we saw also core inflation. So if we strip out energy and food prices, that also picked up a little bit to 5.1%.
So when we talk about this slightly firmer inflation data, how do we think it marries versus the Bank of England's forecast for inflation?
So it's still, when we look at the shorter term momentum signals or prices, they're actually coming in below what the Bank of England is estimating, and that will we expect inflation continue to trend below the Bank of England forecast over the next couple of months, as we see high or large month-on-month prints from last year start to roll out of the calculation, and we'll actually see, hopefully, inflation get close to that 2% target level.
So no disruption to the UK's disinflation trend, just have to wait perhaps a few more months for that to take hold again. Markets adjusting to that. So let's cover the US retail sales.
Yeah.
How do we characterise that number?
So when we think about retail sales and really the US consumer, that has been a huge pillar and real support for the US economy over the last few years post-COVID. And what we continue to see is the same trend. The US consumer continues to spend, and that really helps facilitate stronger economic growth and a positive environment really for equity markets and companies.
And of course, if we introduce the only central banker really to speak this week would be Governor Waller of the Fed. He alluded to that strength, but he did actually talk about rate cuts.
Exactly. He signalled or confirmed that rate cuts would be on the horizon this year, but talked about how unusual this economic cycle or interest rate cycle is to previous cycles. Previously, the central bank would be cutting interest rates after an economic shock or a recession. This time is different. They're allowed to cut interest rates because inflation is on its path for 2%, but also the US economy is still strong. Labour markets are still strong, and that's coming through still in the data. So he's talked about more of a methodical path, a more gradual path perhaps, than what the market is currently pricing.
And I think it's reasonable, isn't it, that we can expect more central bankers to sort of buy into this narrative of rate cuts are ahead, and they'll probably start to talk about it more and more as we head to the rest of the winter. So we're dealing with Western economies right now. Let's head east. China. We had inline GDP data. We had inline industrial production data, but the stock market's telling us a very different story. How would you characterise events there?
Yeah, China continues to be challenged by very poor foreign investor sentiment and poor sentiment more locally as well. There's real challenges with their economy, and it starts with their property or real estate market. That's typically 20-25% of economic growth. That's been in structural decline really over the last couple of years, self-inflicted, but the problem with that is that it really lowers overall confidence, and a hit to the stock market, a hit to property prices means that the wealth effect goes down and people are less willing or confident to go out and spend.
And a big juxtaposition with the firmness we're seeing in Western economic data, so something to bear in mind for the rest of the year. So that's all this week. We really wanted to bring to life the differences in the data we're seeing between East and West and how it's affected market volatility. Thank you for joining us this week. Please join us next week for our morning markets. Thank you very much.